All right. Good morning, everybody. TGIF. We made it to the end of the week, to the end of the month. When we come in next week, we'll start fresh and begin working through all of the data. And by that point, we will have pretty clear insight into Liberation Day and its effects all through April and into May. Start to see those numbers. We're slightly red this morning, but really that's like flat. If we kind of read this as it moved around the world, Asia started out well, Europe better, and then for us, we're just stalled out again. Japan is sitting there with us. Keep our eye on Japan through the day today. It really seems like where we go, it goes, or where it goes, we go. So our fates are tied right now. We're going to get some inflation data today and a better look at the consumer. And then, of course, later this afternoon, we're going to get some Fed speakers chipping their teeth, but it'll be past the end of the day. We've got a number of events coming out of the White House today as well. And of course, that brings with it all sorts of shenanigans that we can see. I didn't catch that yesterday. We got another market closed, so we had an impact on that too. No auctions today, oddly enough. Made it through all of that. The rig count really shouldn't be an issue. So by the time we get into lunch, that should be the end of it, other than whatever comes out of the White House. So 1:30, Trump and Musk. And really, that's the only one. The rest of it is after market close, so it won't matter. 1:30. That'll be the last one we have to worry about. And if you haven't caught on by now, he likes to get on social media before the events and kind of talk trash and push the market around. And so it says 1:30, but I would say be ready in advance because he's likely gonna. It's like watching somebody grab the snow globe, right, and shake it up really hard. Yeah, I would expect that he shakes the world up a little bit before he has this event, like he does with a lot of his other events. Chaos is one of the trade strategies that they've been using for the trade negotiations and tariffs, right? They've said that multiple times that chaos is part of the strategy, keeping everybody off balance. The put wall stayed, hasn't rolled back. They didn't talk about it either, which implied that it wasn't a one-day wonder. Usually, if it's just going to be there for 1 or 2 days, they'll make a lot of comments about it in the founder's note. So their omission added to the idea that it was there to stay. It took a front run against that call wall, and we never got a chance to retest that. But if we do run back up there next week, 6,000 is still the level that we've got to get through. We've talked about this higher low and the fact that we needed to come up and set a higher high, higher than this May 20 high. This little wick here, it counts for some analysts. You know, some are very deliberate in nature, and they'll say, well, wick or candle didn't matter. Price went higher than this price, so we have our higher high. I'm a little more picky than that. I want that candle to at least have body up there, even if maybe a close up there. So I don't like it. To me, that's not enough. We didn't get a higher high. That doesn't mean that we can't, but it does put us in this situation that this range is still the range that we're working on, and we've tightened it up now with that really big bar from yesterday. GTFO, we have to get out of this box. Right now, that's the smaller box of trouble. We are above the 10, 20, 50, 200, but we are fighting with the 4. If we lose the 4 and we lose the 10 is actually on the 20. It's their overlap. It's a lot of structure there. 5892 cog line. So 3 levels. It's the cog line, the 10, and the 200. 5892, if that breaks and we get underneath it, I think it's going to be difficult to get back above it. Yesterday, we had that wick down and that reversal back up. That's the sort of stuff that can happen where we just buoy right back up again really fast. But if we were to actually close below that and maybe even extend a little below that, then coming back up through it is likely going to be very difficult. So we can see that behavior, the 10. That's our line in the sand, whether it's 5892 cog line, 5900 round number, 5911 cog line. That's the channel, that's the zone. We need to keep it. Otherwise, we're going to go for the 20, which is 5826, and then 5800 and on down until at least this low from the 23rd, and more likely the low of this island, which puts us in a threat for an island reversal that we could actually gap back down again into 57 and then lower. The 0 gamma level seems to be shifting lower and lower. I didn't have a chance this morning to go back and look at some of the previous posts this week on where spot gamma's been with 0 gamma. And there is a way to chart it on the platform to where we can just look at, you know, what has the 0 gamma done on a day-to-day basis. I'll put it in the chat once I get that work done. With the put wall over our head and us being where we're at, fighting the volatility trigger, the 0 gamma, like that last line of defense, line in the sand. The idea that, you know, when we get below 10 and I said if we close below it, it would be more dangerous rather than these little wicks down. The 0 gamma here implies that if we did get through the 10, that maybe the risk isn't significant at that point. It would be more significant under 0 gamma. that would put us into an air pocket of risk. And we could see a significant change in the VIX and in the way that dealers will behave with price action. And it's likely that they will sell into that selling, and we would get an exaggerated, swift move to the downside. Sounds like a lot of fun, right? As I mentioned yesterday, if we get to one side early enough, we can go to the other side by the end of the day. And it wouldn't really even be considered all that bearish. So it's what we did yesterday. We were at the upper edge of the ADR lines. And by yesterday afternoon, we had got really close to the lower edge of the ADR lines. This morning, we're basically flat. We're not near either one, so we don't have a lot of edge towards either one. And we have a very narrow IB, initial balance. So we don't have a lot of expectations on what the market's going to give us today, but we have a really clear roadmap. Get out of this box. It's the first thing we need to do. And it's a very narrow box, which implies that we can't keep it, right? The phrase I generally use is we can't stay here. It might seem like an obvious statement, but you'd be surprised how often that simple thing just gets overlooked. It's too tight of a range. Even for a Friday, we can't stay here. We're going to leave this range. And while it's not a perfect measure of the middle, if we do break through the upper edge of the Globex range, the ADR half is the target. Pretty simple. It's also 59.50. It's the big options level. The only thing that would stand in your way is 59.32 cog line, which is somewhere right around here. Easy peasy. Same thing to the downside. If we break our own Globex low, the target is the lower ADR. Now that would put us on an inside day breakout, so we would have to be concerned with the 111 and the 1236 of yesterday. But since yesterday was such a big day, that when we lay out those measurements, you'll see that very likely the 111 will end up there. What I just measured here was the RTH only. And if we were to take all of yesterday instead of just the RTH, you'll see that the 111 is also the ADR half. Funny how that works. The 111 is where we oftentimes will see the opposite candle color, where we end up flipping around and coming back inside again. If we manage to get through that and get to the green and close, that does line us up for a continuation to the other ADR low line. But really, that kind of weakness and that kind of sell-off today isn't really on the table. We're a little soft. We're holding the line, but we're going into the weekend with, so far, nothing really negative against us. We're going to get that inflation data this morning, and that could make the market a little grumpy, and we could see a little temper tantrum, but not really expecting it. And if we were going to see anything from, the bond side of things, we would have seen it after yesterday with Secretary of Treasury chipping his teeth, and we didn't see that either. So hard to see why they would show up today unless the inflation numbers are really nasty. So we've got a really simple layup at this point. Get out of this box, and you got your targets. We do have a market maker move this morning. If you look at the things that are on this list, something on here has them concerned enough that they are buying extra protection. They're putting on additional hedges. They would not do this if they weren't concerned, because it costs them money. When you and I hedge, a lot of times we can do it in a way that doesn't cost us anything. Maybe it ties up a little buying power, but it doesn't really cost us very much. When they hedge, it's pure cost. It's like lighting money on fire and throwing it in the fireplace. The question is, which one of these events is the one that they're concerned about? The base case argument would be the core PCE. It's the highest impact level. It stands out, seems pretty obvious. But the numbers between consensus and previous are nearly in line, right? There's not much of a shift here. So what are they concerned about? Outlier numbers. These numbers often get leaked in advance to where people on the street know, but like the average Joe Schmo, you and me, don't know. Maybe they already know the numbers. And that's not, conspiracy tinfoil hat stuff. That's just the fact. Oftentimes, we'll see those numbers posted out on social media by large funds and firms a day in advance. Whatever it is, they're hedging this morning. And we know that they're hedging. This isn't my opinion. I'm not guessing. We can see that they are hedging. If we get through 8:30 and this number does not start to go down, then that wasn't the event. If it stays this size or it continues to grow after 8:30, it's something else. Now, the hedge that they're using is going to expire by the end of the day. So at some point, even if they didn't take it off, this would start to decrease because it's just running out of time. But that would be later in the day, past noon at some point, when we would start to really see the effects of time and witness that decay. And it's very likely that they'll unwind this hedge after whatever event happens that they're concerned with. It's very likely the core PCE. Just keep your eye on it, because we're making an assumption that that's what it is. Today's floor pivot is a really wide channel, and we are underneath it. So that's why it's red. It's bearish since we opened underneath it. The wide channel implies that if we break out, it doesn't stick, and we come back inside the range again. But when we think about what that breakout would mean, for the upside, we'd have to run all the way up and get above yesterday's high and then keep that. And this says that's very unlikely. But on the other hand, to break out of yesterday's low, well, that's a lot closer. And that's a lot easier to do. But this wide channel does imply that even that, we would very likely come back inside again. Someone just asked about the market maker move. If you have Thinkorswim, every one of these charts that I use in the morning is in the YouTube video description. So if you go to the replay link, you just jump over to YouTube. I put every Thinkorswim chart. I shared the whole chart, right? That way you don't have to apply the indicator and mess with any settings. You can just load the chart the way that I use it every day. If you're not on Thinkorswim, As long as you have options data, you can get the answer that you're looking for. Here's the 0 day. And then you have the next day out. When the 0 day is higher than the next day out, you have the situation called a market maker move. And we can see that right here, that tiny little MMM from Thinkorswim, right? So they invented it, they made it up. Other platforms don't have it. And it has to have options data. So TradingView doesn't have it because TradingView doesn't have options data yet. They got some stuff in beta that's pretty cool, but as far as I know, they're not running functioning options tables, so they don't have the data yet. It doesn't have to be futures either. If you search the Schwab website and you type in market maker move, they'll talk about earnings and equities, and that's what they've always used it for. I hijacked it because it works really well for futures in the AM. So there's also the Thinkorswim workbook. I have a library of thousands of indicators and charts, watch lists, columns, options indicators. So if you go to that Thinkorswim workbook and you search for the market maker move, you'll find the indicator in there. We haven't hit today's pivot point. There's a high degree of certainty that we would, right? That's what markets do most of the time, is hit their own pivot point. But right now, we're completely outside the channel and we have a missed daily pivot, MDP. I was wondering if it was going to line up with the midpoint. It doesn't. The midpoint of yesterday is the upper channel edge, which is basically the 59.50 options level that we would need to be concerned with. But yeah, otherwise, we're not very far from the weekly pivot. We're still outside the weekly channel. If we break yesterday's low and we look at that measured move and the lower ADR, every other level that we've looked at underneath yesterday's low, it comes out above this weekly floor pivot. So if we get through all of that, 58.50, really close to this, it'd be a big options level, and it would be the last line of defense for moves of this week. If we get below that today, I think it would get really, really ugly today. It's been a while since we've had such a nice distribution like this. I mean, it's a little odd on the week, but take what we can get. So that little loop-de-loop from earlier in the week, we did leave a little bit behind up here, but otherwise most of the action is concentrated through the center as it should be. If we break to the downside and we look at that 58.50 that we were just talking about, it does line up with this lower high volume node zone, but it's on the lower edge of that zone, which means it's likely they will front run that 58.55, 58.60, 65, something like that, right? That they would front run 58.50, as they should, right? If you are worried about them beating down the door, you put obstacles in front of the door, right? They have to get through the obstacles before they get through the door. there's nothing else down here, right? If that 5850 fails, then I like 5700 and the gap close. We're only talking, 200 points ish. We can easily do that. That's a one-day wonder right there. $10-day, 30-minute volume profile and TPO. The point of control on both are still lined up nice. We're going to start taking these candles out over the next week. And with that, we would expect to see price get a new point of control somewhere. At this point, it's very likely that we'll see that point of control come down into 5860. Or if we do stay in this range here, that maybe the point of control doesn't get moved at all. I really believe it's going to get shifted down here as these candles get taken off the board, right? We're going to lose these, and that point of control is going to shift down and very likely be down here somewhere. As long as we hold above 5850, that would keep us above that point of control. So it would be moved down and be underneath us, kind of help us out a little bit. We didn't leave anything behind across the top that would make me believe that the point of control would move up. So at least we do have that. It's not much. We take what we can get. Classic distribution yesterday, lowercase b, with the point of control at the bottom, as it should be, right? Just makes sense. And then this morning's really tight distribution, that narrow IB, initial balance. Now, each day this week, we've been putting in the work lower and lower and lower. If you look at every one of these points of control. Now, sure, Monday is the odd one out, but Tuesday we set the high. Wednesday was a little lower, and then Thursday it was a little lower again. So far today, it's lower again. We're just working our way back down to it. I don't expect that Monday is going to help us out at all. But that overnight between Monday and Tuesday is really the only thing that we have left down here, right? And it is above that 5850 that we've been talking about. So whatever that level happens to be, 58, 60, whatever, kind of worth evaluating that. Keep it above 58.60 today. I don't even think it's 58.50 at this point. So every day I share the morning briefing link so that you guys can join the stream. It has the YouTube or the Zoom link every day. I share that post. Go back and look at the post and read it, and you'll see either a direct.me link or you'll see a button that says replay, depending on where you happen to be at, right? Because I share it in different places. So you can't miss it because it'll say replay or there'll be a direct.me link. And that'll take you to my YouTube. The reason I'm saying that is I'm not one of those YouTubers that is trying to monetize my YouTube and tell everybody to like and subscribe and blah, blah, blah. And I don't care, right? I'm not trying to make money on my YouTube. So you can find it. Just go back to the Zoom link and look. We're above the 10-week still. And we held it nicely for this week. We're not extreme. We're not overextended. It doesn't owe us any sort of correction. We're just really sitting in a good spot. Everything that happened this week from the weekly standpoint, we're still good. On the daily, as we saw on the 5-minute chart earlier in the stream, we bounced off that 10 multiple times this week, but we've held above the 10 so far. And I think that's going to be a key piece to all of this. We can see the slope. Now, sure, we had a little bit here in the middle, but the slope has been clear. We're working our way back down. The slope can suddenly change where we go in the other direction. And as choppy and nasty as this looks, it is a bit of a wave. If I zoom out, you can see the blue line a little more clearly. But it is a wave, it is a trend, and it's just this oscillation back and forth. So we've reset, we've found our mid, and the question at this point is, are we going to, come back to the mid and then rise again, or are we actually going to get a cross through? There's no reason to try to guess or assume that we know which one we're going to get, just that it's got to be one or the other, right? Because those are the two choices. Would like to have put in that higher high first before we get a crossover and we get underneath the 10, but we don't always get what we want. We have next week's range laid out for us, and we're back to using those lines. We don't have to run our own calculation like we did this week. 60.11 on the upside, 58.24 on the downside. We can't really compare it to the current week because that wouldn't be fair, the current week, being a holiday week. So we want to measure the projection of next week and compare it to the measurement from 2 weeks ago, which was also a 5-day week, right? Just to compare apples to apples. The range looks very similar. So there's really nothing showing up from a volatility standpoint. If they were concerned or worried about something, we would have seen it elevated or really compressed, right? The idea that big scary events can be volatility suppressing, like FOMC is volatility suppressing. We can see a narrower week on an FOMC week. But the week is not narrow next week. It lines up. So whatever we have on the deck isn't scary enough to warrant a reduction in markets. What that means is we're not going to go sideways waiting on data, right? If we were waiting for big job numbers and we were going to go sideways for a couple days, the range would be more narrow. Or if we were waiting for FOMC on Wednesday and we'd have Monday and Tuesday that's really sideways, the range would have been more narrow. Now this range isn't set in stone yet. It won't lock into place until after 4, after the market closes tonight. So what we measured is just a projection. It doesn't count yet. It won't count until after the close. But it gives us some insight, even this early in the day, on what's being projected for next week. If you don't have Thinkorswim or you don't have that indicator, it is next Friday's implied volatility average right there, that plus or minus line. So after the close tonight, you would take that number and add it to the close for your upper line, subtract it from the close for your bottom line, and that would give you next week's range. Now you can do this for every single day, right? There's a 0-day range right there, $42.50 or 42.5. That's what we call a dynamic expected move because it's constantly changing. The one that we're using on the weekly is a static expected move. We set it and lock it into place. And taking a look at what's moving, the benchmark is 0.5%. And if we look at what's down this morning, we got uranium, precious metals, miners at least, China, biotech, and China again. And the VIX is down a bit. It's a little odd. Yeah. All right. And for things that are up, nothing. We got nothing up more than 0.5%, or at least 0.5%. We don't have anything. On the one hand, that's not necessarily bad. You know, it sucks as a day trader to come in and find that everything's already jumped to the upside 1.5 or 2%, and then there's nothing really that we want to mess with, and we wait for a rug pull and try to trade it back in the other direction. So if we come in and nothing has jumped to the upside at all, well, yeah, that leaves us room to stretch. Unfortunately, though, we got a lot of things headed to the downside. So the things that are up, that are at least near our benchmark of 0.5%, is pot stocks and staples. Not exactly what we need for a trend day to the upside. So China, precious metals, miners, small caps, crude, financials. I guess the only saving grace out of that list that I just named is it didn't have broad tech or consumer discretionary. There's 3 sectors that we need for a rally, whether that's a bullish rally or a bearish rally. And it's finance, tech, and consumer discretionary. Well, finance is down, but not the other 2. So we can hold the line and not go lower as long as the Mag 7 doesn't jump on the bandwagon, and or generically speaking, broad tech doesn't jump on the bandwagon. That would be the thing to watch for today. We had a lot of concern with yields anyways, which, you know, it didn't pan out, and that's fine. We didn't want to see things crash and burn. But we also don't want to see big moves in those prices either. So we got the 10-year pointing straight down. Oddly enough, we got the S&P also pointing straight down. And the dollar, a little bump to the upside here, just to kind of go against the grain. But it is also pointed down. The difference is that it's not below this low here yet. So in that pause, we had this pause and this pause. The 10-year and the ES really didn't rise up. They just went sideways. The dollar took a little bit of a rise up. So that gave it more room to fall. But right now, all three are falling. So this is what we want to keep our eye on. Something is up. It ties in with the market maker move that we saw, showing us that they are worried about something. I don't necessarily want to say they're scared, but they're worried, or they wouldn't have hedged. And this is picking up speed. So, some days we look around and we say, what's moving the market? 0-day options? Well, not this early. Dollar, yields, treasury, bond, foreign markets, news, headlines, earnings, right? We can go through a checklist and ask which one of these things is moving the market today. We're not seeing the flip yet. Ah, I got you. Thanks for that. There was a social media post from the current administration, and that seems to be what just sparked this move. Well, simple enough. We needed to get out of the box. We are out of the box. So it's game on now. Just be mindful that candle is a liquidity event candle, right? It's a liquidity gap. So we can mark the start of it up here. And if we do get a V bottom or we start to turn around, that is your target back to where we started. Keep your eye on the clock. Tweets or no tweets, we still have data coming in, and they were worried or they wouldn't have been hedging. You can't hedge against a tweet that you didn't know was coming. So either put the tinfoil hat on and say they were hedging because they knew he was going to tweet, or they were hedging because we still have data coming in 20 minutes. Everybody, be careful, be safe. If you can't find those links to my indicators that I use and the charts that I use, hit me up in a direct message. I'll happily share them, right? That's the idea. I happily give away all of these tools and indicators. You want them, you can have them. I'll show you where to find them. Everybody, enjoy your weekend. See y'all next week.